Welcome to the Deep Dive. We're here to help you cut through the noise and get genuinely well-informed with those insights you might not find elsewhere. Today, we're really digging into the financial markets for the week ahead. That's August 25th through August 29th, 2025. Our mission, really, is to unpack a pretty comprehensive market report, pull out the key takeaways, and help you understand, the big investment themes and catalysts shaping things right now. And the backdrop. Well, it's this ongoing sort of tug of war between inflation that just won't quit and these signs that maybe, just maybe, the economy is starting to slow down. All this is happening, of course, after the Jackson Hole Symposium, which kind of reset expectations around interest rates. It feels a bit like the soft landing's final exam.
It really does. And that tug of war, it's not just talk. It's the absolute core tension driving everything. Figuring out which way that rope is actually pulling is, well, crucial this week, especially since we have so much data coming out that could either confirm what the market thinks or completely throw a wrench in the works. The non-obvious thing for me is just how fast the market priced in that Q4 rate cut. There's this hidden risk maybe of being a bit too optimistic.
That's a really good point, that potential over-optimism lurking underneath. Okay, so let's unpack this. Maybe start with a quick look back at last week, ending August 22nd. The big story, like you said, Jackson Hole. We heard hints from Fed officials. Well, the market heard hints of a dovish pivot.
Right, the idea that the Fed might cut rates sooner than everyone thought.
Exactly. And that definitely gave bonds a bit of a lift, a more bullish outlook there. But like you said, it wasn't straightforward. You still had these concerns about tariffs pushing up inflation. Plus, the economic data was kind of all over the place. That tug of war kept going.
Yeah, and what was really striking was how quickly the market jumped on that dovish pivot idea. Bond yields. They pulled back pretty sharply.
Directly reflecting those changing rate expectations.
Precisely. And you saw that ripple into stocks, too. The S&P 500, the NASDAQ, they ended up relatively flat for the week, but boy, there was some serious movement during the trading days.
A lot of volatility.
A lot. And the US dollar index, the DXY, it trended down slightly, which, makes sense if the market's expecting rate cuts.
Okay, and what about specific sectors? Did we see clear winners and losers from that immediate reaction?
Oh, absolutely. You could definitely feel that risk-on mood bubbling up in certain areas. Technology, communication services, especially the companies, really tie it into the whole AI theme. They showed some definite strength relative to the rest of the market.
So investors were ready to jump back into growth if the Fed signaled easier times ahead.
Seems like it, but then you look at the other side. Rate-sensitive sectors like real estate, utilities, they kept lagging, mostly because of those ongoing affordability issues. A rate cut might help eventually, but it hasn't fixed things yet. And for you listening, this isn't just old news. How the market reacted last week, that's setting the baseline for how it's going to interpret everything this week.
Right, so last week was the setup, and this week is the test. Okay, let's pivot then to the week ahead, August 25th through the 29th. And it is definitely packed with important economic data points you really need to watch. First up, Tuesday, we get the Consumer Confidence Index. This one's always big, tells us how households are feeling and maybe how they're planning to spend.
Yeah, and it's not just the headline number. You want to look inside,
Yeah.
How confident are people about jobs versus just feeling maybe less worried about an immediate recession? If it comes in weaker than expected, that feeds the slowing economy story. Good for bonds, probably, but maybe pressure on consumer stocks.
But if it's surprisingly strong,
That could spook the market a bit, might be seen as inflationary, push yields back up, and challenge that whole soft landing narrative.
okay, then Thursday is a doubleheader. We get revised Q2 GDP figures and the weekly jobless claims. The GDP revision gives us a clearer picture of how things were really looking last quarter. If they revise it downwards, well, that strengthens the argument for the Fed to cut rates.
Think of them as like two vital signs checks. Jobless claims, that's your real-time pulse on the labor market. A big jump there. That's a serious recession warning flag.
Okay.
And yeah, a downward GDP revision just gives the Fed more breathing room to ease policy. That would be particularly good for what we call long-duration assets.
Right. Those tech stocks and other growth companies whose values tie way out in the future, lower rates make those future profits worth more now.
Exactly.
But the real main event, the one everyone's laser focused on, is Friday. The Personal Income and Outlays Report, and specifically the PCE price index inside it.
This is it. This is the Fed's favorite inflation gauge.
Why PCE specifically? Why not the CPI that gets more headlines sometimes?
Well, the key difference is PCE accounts for substitution. So if steak gets too expensive and people buy more chicken, PCE captures that shift. CPI doesn't really. PCE also covers a broader range of services. It's just a more comprehensive picture from the Fed's perspective. So if we had a hot reading on core PCE that's excluding food and energy, that really complicates things for the Fed's easing plans. Bad news for stocks, bad news for bonds.
But if it comes in cooler than expected.
That's the dream scenario for the market right now. It would be a really strong bullish signal. Suggests inflation is finally cooling enough for that Q4 rate cut everyone's hoping for. Honestly, this report is the litmus test. It either validates the soft landing story or throws serious doubt on it. It impacts everything.
Okay, so beyond the big macro numbers, there are also some key company earnings and, global things to watch. These give us kind of ground level clues. On the earnings front, Salesforce CRM reports its Q2 results. What are we watching there? Growth in their main cloud businesses, obviously.
Right. Yeah, but the real interest is going to be around their data cloud and AI stuff, particularly their Einstein platform. Are companies actually spending on AI tools yet? And maybe even more important, what's their forward guidance? What are they saying about overall enterprise spending? That's a huge signal for the broader economy.
So Salesforce acts as a kind of canary in the coal mine for business tech spending.
Pretty much. If they sound optimistic about AI and cloud deals, it suggests that whole AI investment boom might be starting to spread beyond just the chip makers. It tells us if businesses are actually using these tools, which is good news for a lot of tech companies.
Got it. And then we also have Best Buy, BBY, reporting its Q2. This one feels like a direct pulse check on the consumers, especially for electronics.
Oh, definitely. Best Buy gives us a really tangible feel for that gauging the consumer theme we talked about, especially when you look at it alongside Tuesday's confidence number, what they say about spending trends, how much inventory they're carrying, and crucially, their outlook for the holidays. That's real-world data on whether people are still buying big-ticket items or starting to pull back. Very important for understanding discretionary spending.
And globally, still watching Fed speakers digest Jackson Hole, looking for consensus on rate cuts.
Always. And keeping an eye on trade tensions, any geopolitical flare-ups, those are always in the background. Plus, we get Eurozone inflation data. That could move the needle on what the European Central Bank does.
How does something like Eurozone inflation impact us here, maybe through the dollar or specific companies?
Good question. If Eurozone inflation is surprisingly strong, the ECB might have to stay tighter for longer. That could strengthen the euro against the dollar. A weaker dollar can be good for some U.S. companies with big international sales, makes their goods cheaper overseas. But a significantly stronger euro could also put pressure on the dollar itself, impacting import costs and broader inflation dynamics here. It's all connected.
Okay, so let's connect the dots. This is where we try to figure out what all this means for specific high-profile stocks this week. Let's start with Microsoft, MSFT. The theme seems to be AI leadership and enterprise spending barometer. The thinking is Microsoft's a core AI play, and how it trades tells us about institutional risk appetite, but it's also sensitive to that PCE report, right? Because it's a long-duration asset.
Exactly. But the interesting thing with Microsoft isn't just the AI angle, it's how diverse their business is: cloud, productivity software. That gives them a bit of a defensive quality. So even if, say, PCE comes in hot and shakes the pure AI momentum plays, Microsoft might hold up better. The key catalysts: definitely Friday's PCE because of the interest rate impact. And yeah, Salesforce's earnings give us that broader clue about cloud demand. If PCE cools, expect Microsoft to probably lead higher. Hot PCE might cause a dip, but I agree the fundamentals are strong, so buyers likely step in.
Okay, next up, Apple, AAPL theme. Consumer demand and pre-launch positioning. Makes sense. Its fate is tied to how the global consumer is feeling.
Absolutely. It all comes down to those consumer signals for Apple right now. Tuesday's confidence number, Best Buy's results, those are early clues before Apple's usual big fall product launch. And of course, any leaks or rumors about the new iPhone always move the needle. If the consumer data looks weak, yeah, the stock might feel some pressure short term. But honestly, knowing Apple's history, investors often see dips before a launch as a buying opportunity looking ahead to the holidays.
Makes sense. Now, the big one in AI momentum, NVIDIA, NVDA theme. Pure play AI momentum.
Yeah, NVIDIA is kind of the poster child for the whole AI trade, isn't it? But that high valuation makes it very sensitive to interest rates. So PCE is huge for NVIDIA. That said, their fundamental story, the earnings growth, it's incredibly strong. It's a real push and pull. How NVIDIA reacts to PCE will be a major test for the whole AI theme. Is the momentum strong enough to withstand higher rate fears? A hot PCE is definitely the biggest risk here. Could easily trigger some profit-taking in a name that's run so much. Cool PCE probably adds fuel to the fire, sends it higher. Expect bumps either way, though. Volatility is kind of its nature right now.
Okay, and lastly, let's look at a different sector. JP Morgan Chase, JPM theme. Yield curve and economic outlook proxy.
Right. JPM is like a direct window into the U.S. economy and where rates are headed. Banks live and die by the yield curve, the difference between short-term and long-term rates. Ironically, a cooler PCE report, which the broad market might love, could actually pressure bank stocks like JPM if it leads to long-term yields falling sharply. That squeezes their lending margins. So for JPM, watch PCE's impact on the 10-year Treasury yield. Also, Thursday's GDP and jobless claims for clues about the economy's strength. It's actually kind of a tough spot for JPM. It might lag if falling rates fuel a growth stock rally, but it's also vulnerable if recession fears pick up. A stable or gently rising yield environment, that's usually the sweet spot for them.
So pulling it all together, what does this really mean for you navigating this week? The main story seems pretty clear. It's the market caught between hoping the Fed pivots dovish and fearing inflation stays hot. And the number one question is, does Friday's PCE report give the Fed the green light for that Q4 rate cut everyone seems to expect? Because right now, the market is definitely priced for that soft landing, that smooth shift to easier money.
And that setup gives us some pretty clear if this then that scenarios. Scenario 1, PCE comes in cooler than expected. What happens? Probably a strong risk-on rally. Tech, consumer discretionary likely lead the charge. Bond prices go up, yields go down. The dollar probably weakens more. That's your bullish case for stocks like Microsoft and Nvidia.
Okay. And the flip side.
Scenario 2, PCE is hotter than expected. Uh-oh. Expect a pretty significant risk-off move. That challenges the whole dovish Fed idea. Stocks sell off, bonds sell off, meaning yields rise. The dollar likely spikes as rate cut hopes evaporate or at least get pushed way out. Who gets hit hardest? Those high-flying growth stocks with big valuations, defensive sectors might actually hold up better in that scenario. And, keep watching that divergence between the U.S. Fed and other central banks like the ECB. That still plays a big role in currency moves and for multinational companies, no matter what PCE does.
That's a really helpful framework. So it really does boil down to one thing this week, doesn't it? Friday's PCE inflation report. That's the key driver, setting the tone for everything related to interest rates.
It absolutely is. As we've kind of walked through, the market's really balanced on a knife edge here. You've got the hope for a soft landing on one side and the hard reality of stubborn inflation on the other. So the question for you to really think about this week isn't just what the PCE number will be. It's how closely do the market's current expectations actually match up with where the Fed is likely to go based on all the data. And what happens if there's a mismatch? What does that tell you about the economy's real underlying strength or lack thereof? It's a week where surprises could definitely shake things up.
That's a great final thought. A reminder that expectations and reality can diverge, sometimes sharply. Thank you for joining us on this deep dive into the week ahead. We hope you feel a bit more prepared to navigate the always fascinating twists and turns of the market. We'll catch you next time.